Welcome to the program. My name is Marty Schenkman. We have a great, really informative program on an issue that is critical for every estate planner of every discipline. We're going to talk about valuations. There's no doubt that this is going to be a major year for estate planning transfers. We're going to talk about that briefly as an introduction. I'm going to let the speakers introduce themselves. We have Jonathan Blattmacher. Jonathan, why don't you?
Well, Marty, thank you. It's a delight for me to be here with these professionals dealing with the most critical factor in all of estate planning, which is valuation. The name of the game in estate planning is valuation. And every transaction which an estate planner undertakes, whether it's an installment sale to a grantor trust, whether it's a GRAT, whether it's a charitable lead trust, it all turns on valuation. So this is really where the rubber meets the road. Back to you, Marty.
And Todd, why don't you introduce yourself and we'll just go through real quick and mention obviously your firm and.
Yep, hi Marty. Great to be here with everybody. I'm one of the partners at MPI, a business valuation firm. I run our private client appraisal group, and we do hundreds of estate tax, gift tax, and income tax driven valuation projects every year, and happy to be doing this with everybody here today. Thank you.
Dan?
Hi, I'm Dan Kerrigan. I'm the president of MPI. It's a pleasure to be a part of this group. Delighted to talk about all the changes that the current environment has caused in the valuation profession.
Scott?
Hi, Marty. Thanks for inviting us. I'm a managing director at Empire Valuation Consultants. We've been doing valuations for many years. Probably about 40% of our work is on the estate planning side, and we're looking forward to this panel, and we're anxiously awaiting the next 9 months and what's going to happen with everything that's going to be going on in the estate planning with the political elections and everything. So it's going to be an amazing period of time, and thanks for having us here.
And finally, Kevin.
Thanks, Marty. Thanks for having us. Kevin Kane from Empire Valuation. I'm also a managing director at Empire and kind of oversee our West Coast operations. And we're excited to talk about this very interesting and very exciting kind of time that we're going through. So we're very excited to be here.
Thank you. So I can tell all of you in the audience that I have worked extensively with both firms. They're both outstanding, and I'm thrilled to have them here because I want to understand better what it is they do when I hire them to help me on a client matter, especially in this incredible, unusual, hopefully unique environment that we're in right now with COVID. We have two sponsors for the program. Jonathan, I'm going to mention Interactive, and I'll turn it to you for Peak. Interactive Legal is really one of the premier software package for legal drafting of estate planning documents. I'm on their board of advisors. I've been a subscriber for many years. I highly endorse the program. It's phenomenal. It makes you incredibly efficient. As we get on into this incredible 2020 planning year, there could be an absolute tidal wave of planning that we're all going to do for clients. If your firm has not yet adopted document generation software, do it immediately, because you want to get the learning curve behind you, because then you can hit the ground running and generate documents and planning at a far greater speed with far more precision than I think is possible to do without using document generation software. The contact information for Vanessa Canega, who's not only a great lawyer and a wonderful human being, but the president of Interactive Legal, is on the slide. Jonathan, our second sponsor is Peak Trust. Maybe you can make a comment for Peak.
Yeah, Peak Trust, which is run by my brother Doug and my nephew Matt. Some of you may know them because you've worked with them or you've dealt with them at the Heckerling Institute. It's a full service trust company in both Alaska and Nevada. I have sent literally over 100 clients to them, and not one has left. And perhaps more important, to show what I really think of them, virtually all of my family's trust money is managed through Alaska Trust, or now known as Peak Trust Company. So, and I'm the director of estate planning. So if you have some work with them, maybe I'll get the opportunity to work with you as well.
Thank you. As has become my custom for several years now, every webinar that I do, I try to feature a different charity. And I'm honored and pleased today to feature one of the preeminent research institutions on the planet. And we have Stacey Solomon, who will give us a few words about the Weitzman Institute.
Oh, thank you so much, Marty. It's really an honor and a privilege to be able to share just a couple words about the American Committee for the Weitzman Institute. The Weitzman Institute is located in Rehovot in Israel, but it's one of the premier basic science research institutes in the world, consistently ranked in the top 10 in the world, the only one outside of the United States. It just was ranked number 2 as a science research institute in Nature magazine. We are science for science sake, curiosity-driven research. And as a result, though, even though that's kind of esoteric, many of the leading results that we see today are from scientific research from the Weitzman Institute, including the leading drugs for multiple sclerosis, the algorithm underlying the smart chip in credit cards, transition lenses, the amniocentesis, to name a few. And most recently, and there's another slide, by the way, Marty, if you don't mind. We have most recently coronavirus research. We're one of the leaders in the world in looking for both the vaccine and treatment in the meantime, and also in the testing in the state of Israel. Most of the testing, much of it was conducted at the Weitzman Institute of Science. Another thing, we're in phase 3 clinical trials for a universal flu vaccine. So these are just a couple of the examples. If anyone, we have an extensive estate planning, plan giving practice, which I oversee. And if there's anyone interested in talking to me another time, I'd be delighted to do that. So thank you, Marty, so much for this opportunity.
Our pleasure. If you ever have the chance to visit the Institute, it will be one of the most remarkable days of your life. The things that we saw, from fundamental research on brain disease to robotics and on, was absolutely remarkable. Absolutely remarkable. Thank you, Stacey. I know you're going to drop off so that Dan can jump back on with the camera. We're going to get rocking and rolling now, everybody, and dig into the program. We're going to take just a couple of minutes because we don't want to detract too much from the valuation issues. And Jonathan and I are just going to make a few comments about the current environment, why valuation is so vital. We have a number of very detailed, some 2-hour-long webinars on planning for 2020, which you can find on Interactive Legal's website, as well as schenkmanlaw.com under the webinar tab, talking about planning with SLATs, GRATs, SPATs, and all sorts of other great acronyms. And as Jonathan said in the introduction, the key to all this, which is why I'm so thrilled to have both MPI and Empire here, is valuation. Clients really, in my view, and I know Jonathan feels the same way, need to plan. They must plan as soon as possible. If the election results in November provide a change in power in Washington, it seems almost assured that we will have dramatic changes to the estate tax. We can't predict what lines they will follow. It could be a wealth tax. It could be along the lines of the Sanders tax proposal, which was patterned after President Obama's Green Book. But if you don't shift wealth now, you may miss out. So clearly clients need to use wealth transfers today. They need to use them in terms of gifts, to use the temporary exemption. There's been talk that the gift exemption will be reduced to a mere $1 million, from 11.58 to $1 million. That is an incredible opportunity to go to waste, and dramatically greater than what drove the tidal wave of planning in 2012. And if we have time, we'll talk a little bit more about what that may mean in 2020 at the end. In addition, this is not only about using exemption, and this is where Empire and MPI appraisal firms will shine. For higher net worth clients, using exemptions may only be a small down payment on the wealth transfers they need to make. So whether it's GRATs, note sales, after the exemption amount is used, some combination of sophisticated planning should be pursued to freeze and remove wealth from the estate. The proposals that Bernie Sanders made in the Senate and Congressman Gomez in the House last year decimated or eliminated discounts. So if you have clients with discounted values, and this is even before the issues about what COVID may do to it, now is the time to plan. Jonathan, the last comment I just want to make before I turn it over to you for a few comments is the last point on the prior slide is that many times we'll all see as practitioners, clients use their regular CPA firm to do an appraisal. Many CPA firms have outstanding appraisal departments, and I've worked with many of them. But be careful and think about if it's an accounting firm that's doing regular financial work and accounting work for the client. Are they really the most objective when you face an IRS audit? Do any of you from Empire or MPI, even if it sounds self-serving, want to make a comment on that?
You know, some of the firms they do a great job, as you've said, but at the same time, we agree that there is an understanding that you may have client relationship that allows for adjustments that may or may not be appropriate, and whether that happens or not, it's just a potential risk factor that the IRS under audit could raise. So yeah, I mean, we would agree independent appraisals make a lot of sense, and it's self-serving. It makes a lot of sense.
Just to add one more point to that, this is Dan Kerrigan. As we'll see in this presentation, getting deep into the weeds on valuation and doing it every day will capture the nuances that we're forced to capture now that the world has changed as it has. So using firms that do this every day, that understand those nuances, is ever more important.
Good point. Jonathan, do you want to make a couple of comments on valuation adjustment clauses? And I may interrupt you, and also about a recent case on valuation adjustment clauses that could be important for people to be aware of.
Yes, I do, Marty. One of the things you don't want is a surprise in valuation. I was involved with one case where the IRS claimed that the asset in the person's estate was 40 times greater than what the estate's appraiser put it at. It was bitter, it's prolonged. I've had not quite the same 40 times, but I've had 20 times at least raised in gift tax audits. It's also important to keep in mind that the IRS makes more money by changes in valuation in estate and gift tax audits than all the legal issues combined. So we lawyers who think we're so smart to figure out how to do things in the best manner for the client, we may fail if the valuation is wrong. There's a recent case that is very worthwhile reading called Nelson, just decided by the United States Tax Court, in which a person made some lifetime gifts and also made a lifetime sale to a grantor trust. Now, the taxpayer tried to use a fixed dollar amount as the amount of the gift by saying, I'm giving so many dollars worth, or I'm selling so many dollars worth. But unfortunately, the taxpayer didn't add, as finally determined for federal tax purposes or federal gift tax purposes. Rather, the taxpayer said, at least the court interpreted what the taxpayer said as determined by an independent appraisal. The court therefore said that it didn't matter that you really may have intended it to be a fixed dollar amount of the transfer. You said it was up to the appraiser, and that was wrong. The real lesson here of it is that if you want a fixed dollar amount, which the courts have approved in a number of cases, including Christensen and Petter, and perhaps the best of all, the Wandry case, to which the IRS is non-acquiesced, by the way, you say, I'm giving a certain dollar amount of this property as finally determined for gift tax purposes on this date of transfer. Now, does that mean that you don't need an appraiser in the process? No, it does not. What you need to do is just go to an appraiser and say, I want to transfer, for example, all of the non-management interests in this LLC to a trust or to family members. What I want you to tell me, and I don't want it high, I don't want it low, I want it exactly right. Although I realize that's impossible, tell me exactly what those non-managing interests are worth. So the appraiser comes back and says, we think they're worth $5 million. You're going to go ahead and transfer either by sale or by gift the lesser of all of the non-management units, or $5 million worth as finally determined for gift tax purposes on the date of the transfer. That's very, very important to do. I've used it extensively. IRS has never successfully challenged me on it. And in fact, if you go to Interactive Legal, you'll see some language which we recommend you consider using, dealing just with this. That's in when you go into the trust, and it says, do you want to make an installment sale? The other thing that can be done, and Marty has it at the bottom here, is to try to do it in a manner that any excess, if there is any excess, goes into a trust, which would be an incomplete gift. You do that by giving the grantor some sort of power of appointment over the property, or to put it into a trust in which the grantor is the sole beneficiary for life. Those are important things to do. But I'm telling you, if you go out and try to make transfers and don't rely on a professional appraiser, you're making a mistake for your client and for yourself.
Marty, you're on mute.
Marty, you're not being heard.
Sorry about that. We may have one of the last great opportunities for wealth transfer planning. And just very quickly, one of the concerns we have with the Wandry clause, or a defined value mechanism, which says I'm giving, $5 million of stock, I'm selling $100 million of stock, that residual that remains if that clause is triggered is in the estate. And under the Powell case, and I don't want to spend too much time on it because we got to get to the meat of the valuation that we're going to primarily talk about. That residual in the estate could pull the entirety back in the estate, because then the decedent, in conjunction with others under 2036A2, may have controlled an interest or had an interest in the entity. So something to think about when you're crafting these clauses is maybe you want a second tier, or what I called a double Wandry, where I'm selling $100 million worth of stock in this corporation. If there's any residual left, I sign a simultaneous agreement to sell that for the gift tax value finally determined. So it too is removed from the estate. You get everything out. One of the interesting things, and we're going to now jump into the appraisal, is, and I may be wrong, I'm going to learn this as we go through the webinar from the appraisal experts. It just seems, and it may vary by business, that for some of our clients, the uncertainty of predicting what the value may be could be greater than it's ever been. So it may be more important than ever to spend time to focus on these adjustment clauses, because even a good faith effort may be subject to a lot of uncertainty. So let's start to dig in, and we're going to get an executive summary of what's to come.
Thanks, Marty. Appreciate it. Welcome again to everybody out there. Today, we're going to conduct a wide-ranging discussion that sits at the intersection of estate planning and valuation. 2020 has been quite a year, and yet there's still 6 months to go and an important election coming up in November. For many of our collective clients out there, this year has been painful, as client balance sheets have been dramatically altered, and many closely held businesses have been hurt by the COVID-induced crisis. The silver lining for many clients is that this environment has created an interesting wealth planning opportunity, adding to several dynamics already in place at the beginning of the year that suggested that 2020 could be a good time for wealth transfer planning. There's a significant flow of clients and advisors coming now to ask firms like MPI and Empire about how the values of closely held interests have been affected by COVID, and how the valuation process may be altered during this difficult period. Today, we'll cover 6 important topics, as shown here if we go to slide 8 here, including matters of timing, the highly volatile stock market, valuation approaches relevant in this environment, the state of valuation discounts, and considerations with respect to real estate and art appraisals. We'll also peek into our collective crystal balls and tell you what the remainder of 2020 may look like for wealth planning professionals and valuation experts. Marty, if we could go to slide 9, a quick housekeeping item. Please note that the content provided in today's webinar has been prepared without taking into account any specific objectives, financial circumstances, or needs, may not be relied upon, and is not a substitute for competent legal and financial advice. Nothing herein constitutes an offer to buy or sell securities. With that, Marty, if you wouldn't mind, could you please introduce our first topic on slide number 10?
Sure. So let's start with a question. And one of the things for you in the audience that was very helpful, the way MPI and Empire, who prepared all these materials and deserve kudos and applause for it, everything is laid out topically. So it'll be easy to follow because each topic is laid out with separate slides with sort of a topical divider slide between them. Valuation date is something that's very critical during a valuation because it determines what an appraiser should or should not consider as relevant to the valuation. Many companies will do an annual valuation on, December 31st. But what relevance does December 31st last year, pre-COVID, it seems like a lifetime ago, December last year, we used to go to restaurants, right? And to the gym. What is a 12/31/19 valuation? What relevance does it have? How has the coronavirus and economic results impacted it? Is there any other specific date or anything else that triggers when a valuation should be considered? And I'm not sure if it's here or not, but maybe you want to comment as we go through this on staleness as well, if that's not elsewhere in the outline, just so people know when they need to update if they're doing planning later in the year.
Sure. Thanks, Marty. This is Kevin Kane from Empire. I'll start off addressing this particular topic. So, when we talk about valuation dates, I think the underlying premise that we are really getting at is what is known or knowable on that valuation date. So the concept of known or knowable, I'm sure if you've worked with appraisers before, it's something you've probably heard us talk about. And it's something that we really focus on. So when we're doing retrospective valuations, it's something that we can really hone in on, is what areas do we really focus and what information is relevant to the valuation on that particular date. So obviously with most valuation work, there is no absolutes in anything. So we really kind of have to take it on a case-by-case basis. But one of the ways to kind of assess the overall impact of the COVID-19 situation is we can kind of take a look at the U.S. markets, U.S. stock markets, and giving some guidance as to what the markets did and how they reacted to the news. So Empire did a pretty lengthy event study and kind of looked at the time frame from the beginning of 2020, through basically till today, and looked at what the various event data points suggest and how the market react during those things. So you can see on this slide, this is a slide of the S&P 500. And as I said, goes from the beginning of 2020 through, in this slide, it goes through about the middle of April, which is kind of where everything is kind of full-blown COVID at that point. So from a 50,000-foot view perspective, the guidance, can really be looked at based on, where did the market really start to take a turn. And so for many people, like when you have a significant historical event, there's likely some sort of triggering memory in your mind as to what started it or what was significant related to that event. And the way I look at it personally is Wednesday, March 11th was a very significant day for a lot of reasons, but one that kind of sticks with me is that was the day that the first NBA player was diagnosed with COVID-19, and the NBA decided to suspend the rest of its season. Well, from there, everything sort of cascaded. The NHL and other sports leagues suspended theirs. You started to hear more politicians speaking in regards to the quarantining and slowing and shuttering businesses and having some businesses close. Some businesses had to move remotely. So I think it's fairly obvious that, starting the middle of March onward, you're looking at situations where if you have a valuation date in that area, you're certainly going to be taking COVID into account. And a lot of the rest of this webinar is going to be talking about how we do that and what things are we looking at and what changes to some of the inputs that we're going to be covering. So if you look at valuation dates prior to that time period, so if you look at what the market did sort of from the beginning of the year till the beginning of March, for the most part, it kind of held flat up until the latter part of February, where there was a little bit of sell-off, and then, kind of in March is when things really kind of died off. So it really becomes case specific if you're looking at valuation dates between, say, the first of the year and at mid-March timeframe, because depending on what industry you're in, what geographic market you're in, things of that nature, you may or may have different impacts. I do a lot of work on the West Coast, and a lot of the companies there had very strong ties to China and saw the disruption from their manufacturing and their supply chain impacting their companies and becoming more of a day-to-day conversation piece on the West Coast, I think, before the East Coast did. So a lot of it's going to depend on your particular situation. Now, we talked about 12/31 as a valuation date that many companies use. They do annual valuations for a lot of reasons. Could be corporate planning, so they're going to be doing stock option issuances. They're going to be doing some sort of stock transaction with their shareholders. They're going to potentially, maybe they're an ESOP company, so they've got to do an annual valuation as of 12/31 for their reporting purposes. But I also got a lot of ESOP companies that were do the annual valuation as of 12/31, but then use it again later in the year for doing other transaction purposes. So I think really when you look at the data and the history of the news events, really anything 12/31 or prior, anytime in 2019, is really likely not to have COVID-19 as a significant impact. So for what do you do for these companies that do these annual valuations and use them maybe for a couple different purposes? So I've spoken to several of my clients where they've had that situation and they've done a couple of different things. Some people have even said that they're just going to suspend any other subsequent transactions until after they get a better understanding of the overall impact on their business. But other ones are suggesting, other people we've talked to will have update valuations done. So I have one client who ultimately does transactions usually in the May or June timeframe. So they're going to come back and they're going to do an updated valuation so that we can more correctly match what impact COVID has had on their operations. And therefore, when they do their transactions, the date will be, or the valuation will be much more current. So to Marty's question about staleness, I think you have to take all of those factors into play. So we are going to speak a little bit later on in terms of the industries you're in and the like, but I think a lot of it's going to be case specific as to what whether or not the valuation becomes stale, because you could have some companies that have been dramatically impacted, other companies have had no impact, and some companies have actually seen upticks. So you have to really kind of look at it on a case-by-case basis. So the only other thing that I really want to mention before we move on is that one thing a lot of folks need to remember is that if you are working in an estate environment and you have a decedent who passed away anywhere from, say, August or September onward last year, one of the things you really want to consider is using the alternate valuation date and see whether or not that 6 months later date is going to fall in a time period where the COVID situation is more prevalent and you want to take it into account. So that's something to think about as part of your whole process if you've got a date of death that's sort of towards the end of the year. So at least it's something to consider as part of your overall process. So unless if somebody else has something they want to add, that feel free to do that. Otherwise, I'll turn it to Marty to do the next question.
It's interesting to note the alternate valuation date because for so much of the last decade, the stock market has done nothing but go up, and all of a sudden we now have a potentially radical change. So that's a great point. The point I wanted to make on staleness is I think you need to consult with the appraiser, because whatever assumptions you may have used pre-COVID for staleness may or may not apply today. And I think you're better off asking the question and documenting what the answer is so you have something intelligent to say to an auditor, not that you ignored the issue. So let's go on to now our second topic. Everyone has observed this tremendous rebound in the stock market. Has the opportunity for gifting to take advantage of low asset values due to COVID-19 already passed. I certainly wish that I had bought everything back into the market when the Dow hit 19,000 or 18 and change, but now it's recovered much of the loss. How does that impact valuation? Great question.
Yeah, it is a great question, Marty. And I suppose if your client's only asset is an ETF or a mutual fund that tracks the performance of the NASDAQ 100, which has rebounded to an all-time high, by the way, and that your only estate planning strategy is a short-term grat, well, then maybe you did miss an opportunity. But I think it's safe to say that most clients, their balance sheets are far more diverse. Estate planning considerations go much deeper, and many of our clients own closely held businesses that are still feeling the effects of the pandemic and may not recover to pre-crisis revenue or earnings levels for many years. So the simple answer to the question for many clients is simply no. There's still a tremendous gifting opportunity available. Many of us are drawn to the headline prices of the major stock indices, such as the Dow Jones average, the S&P 500. But the S&P 500 is a weighted index. And while it has 500 underlying components, it's impacted significantly by a small group of highly valued companies, including the Amazons and the Apples of the world. What may be of interest to our viewers is the data shown on slide 14. We went under the hood of the S&P 500 and found some interesting dynamics. As of a few days ago, the average stock in the S&P 500 is down 36% from its 52-week high. 59% of the constituents of the index are down over 30% from their 52-week highs, and the average stock is down 21% year to date. Furthermore, the differences between industries is simply glaring, and this is a theme you'll hear throughout today's webinar. Tremendous differences in the impact of the crisis when you go from industry to industry. It's one thing to be in certain parts of technology, telecom, gaming, e-commerce, delivery services. We know those industries that fortuitously are in good position for a stay-at-home quarantine environment. But many, many more, starting with travel and leisure and on down the line, very much damaged by what's going on and will potentially continue to be for some time. The other phenomenon, and again, this is something that we'll get into more as we go today, is that valuation discounts tend to be elevated during crisis periods. We saw this in 2008, 2009. Generally speaking, when markets are stressed and volatility is high, valuation discounts rise. And there are several places in the markets where you can observe this very directly. So as I like to say, it's kind of a double whammy. The asset values in many cases have declined, but then the valuation discounts have also gone up. Now, regardless of how asset values have changed in 2020, for many clients, still there are several other reasons why gifting or selling assets to the next generation now may make sense. And so if we go to slide 15, Marty, for many clients, the stars have aligned in 2020 for what is potentially a unique opportunity to maximize the efficient use of exclusion amounts and transfer significant wealth at a relatively low cost. There are 4 elements that exist today, 3 of which were present even before the crisis. And we like to say there are 4 stars in alignment. Number 1 being the high exclusion amounts. $23+ million now in 2020 for a married couple. This is in place through 1/1/26. Second, we're in an election year. There's the potential for a significant change in the political landscape. with some speculation that the sunset, the 1/1/26 date, could be accelerated to as early as 1/1/21, or new tax legislation could bring other adverse changes for clients. Third, the COVID-induced crisis has caused declines in most asset classes in March, and the values of many privately held companies and partnerships declined substantially. This created an opportunity to transfer wealth at a lower effective cost with greater upside. And while the rebound in equity markets may have diminished some of these opportunities, numerous industries and businesses have not recovered to nearly the extent as others. And fourth, Treasury interest rates have dropped meaningfully, and really even further in the last couple of months, leading to sharp declines in the applicable federal rate and the Section 7520 rates here in the second quarter and now into July. These low rates provide meaningful benefit to clients doing planning with grants, note-funded sales, among other strategies. And if we go to slide 16, Marty, we summarize the month. Yeah.
Before you go on, Jonathan, I think just on the second point, you should make a quick comment. Many advisors and many clients, more clients than advisors, feel that, I can wait, we'll have the election. If the Democrats take over and it looks like something's going to happen, I'll do the planning after that. They're ignoring the possibility of a tax law, as Todd just said, and I think he made a great point that I want to emphasize. They could make this tax law retroactive. They pass it in March to January 1, 2021. Do you want to just comment on that? Because I think many people assume that's not possible. You got you're mute. You got to unmute, Jonathan.
Try to. Oh, there I am. Okay. I was blocked. Yeah, I mean, we don't know what's going to happen, but the Supreme Court has said that the Congress can make changes retroactive in the estate tax field, even back a couple of years. Now, I don't think that would happen, but if you have a big change in the power structure, and if the Congress and the president decide that they really need to raise funds to pay for this pandemic, and I don't think there's any question but that the cost is going to be multiple trillions of dollars, one area that they may go after and they want to get the money in quickly is the estate tax. They'll make changes to income tax. For example, one proposal that Biden has made is to have all capital gain taxed as ordinary income. And there are many other things they can do in the income tax arena. But the legislation over the past just several decades has been so favorable to the wealthy when it comes to estate taxation, it won't surprise me if they do it retroactively. And that means that, as Marty said at the beginning, clients can't afford to wait to see how the election comes out. They've got to start planning now. And one of the things that you need to do, and some of the guys here know that I do it, when I'm thinking about recommending to a client, or the client has contacted me about recommending transfer of property, I talk to the appraiser ahead of time. I want to know what is the best asset from a valuation perspective to transfer. Or is there some, for example, restructuring of a company or the ownership of something so that a better valuation result can be obtained? That's very important to do, but don't wait until the last minute. As Marty said, maybe it will all be retroactive, but the crush of number of people, especially if you have a power change in Washington, D.C. after November 3rd, you're not going to be able to get it all done by the end of the year. And that's and you got to contact clients now and tell them, let's get in a position that if we need to do it before the end of the year, we can.
Thanks, Jonathan. Let's go on to the next slide. I'm sorry to have interrupted, but it was you made a point that I just thought had to be emphasized.
No, not at all. So Marty, slide 16. This is a summary. The trend in the AFR and the Section 7520 rates since early 2019 through July of 2020. And, the rates had trended down through 2019 and into early this year. And when we couldn't think they would go lower, the crisis hit, and they've tumbled to very low levels, very attractive levels for a lot of these strategies, as you see there on the bottom of this slide. Now, I want to bring in Scott and Kevin, as I know they have some thoughts on this overall topic. Guys, please go ahead.
It's interesting, Jonathan, talking about restructuring and things. I've definitely had clients that have liquid assets within a structure, a holding structure, talking about, finding a different way to move some of the liquid assets out and just leave the illiquid assets and then do the transfers, with illiquid assets that have been hardest hit. It's a kind of a way of restructuring in a sense, as opposed to restructuring a corporate, operating business. But so there are some creative strategies out there with regard to that. But I think your chart on, the AFR is a great example of, what can happen today versus what would have happened, back in January a year ago.
Good to go on?
Yes, sir.
So now we're going to change gears and we're going to talk about another topic. Clients regularly ask about the impact of COVID on valuations and the valuation process. How do you go about valuing a business in this environment, especially those that may be under government orders to stay closed? I'm fascinated by this topic. I know I had a lengthy discussion with Scott not so long ago on it, because how do you predict, how do you forecast cash flows when you're dealing with something that seems to be, not just a black swan event, not just 2 standard deviations, but maybe 3 or 4 or 5 standard deviations out from anything we've seen before. So I'm looking forward to hearing the comments on this, guys.
All right, well, actually, before we get into the actual methodologies, I'll just speak a little bit to lay a little bit of the framework. Marty, you mentioned, the idea that you could have, how do you project the cash flows? And obviously cash flows are the biggest estimate or biggest thing that we do as part of valuing a company. So, obviously it could be a revenue impact, but it could also be an expense impact. So as we go through that, there's a couple of, bigger theme issues that we have to kind of take into account. One of which is really, how is the recovery going to take shape? People use different letters to describe the shape of the recovery. Is it going to be a V shape, a W shape, or a Nike swish, or whatever? So there's a lot of different things that we can expect, and we could have different scenarios with different possibilities. And the second, kind of thing to really think about is really, we talked about industries before, and it kind of follows along those same lines, but there's a lot of terms that people are using today, basically using the terms essential versus non-essential businesses. And we talked about that a little bit in terms of, you got some companies that are essential, so they've never shut down. They've always been operating. They may have actually seen a boom in their business. So you could, if you're in some of the medical fields, or if you're Zoom or somebody like that, that's really taken off because of this, you could have one sort of set of cash flows. If you've got a company at the other end of the spectrum, the travel or leisure, what about the cruise industry? Are people going to want to take cruises after this? Most of the hospitality industry businesses that we've had work with, that they've basically had to shut their doors and haven't, the question is whether or not they're going to reopen. I've got one client who basically handles, their main part of their business is handling the concessions at all of the sports arenas and stadiums. They basically have no idea how they're going to move forward until they figure out how sports are going to come back. So which category you fall into will have a huge impact on the projected cash flows that you're going to use as part of the valuation. And along with that is, what is the consumer behavior is going to look like on the backside of all this? If you're talking about sports, are people going to be willing to go back into stadiums with 100,000 people? What are you going to do as you try to enter the stadium, or you try to go buy concessions, things of that nature? How do you social distance in all of that area? So those are all logistical problems that these organizations have to figure out, but are also going to be difficult in determining the economics of those businesses. Again, I mentioned cruise lines. Are people ever going to go on cruises again? What about the brick and mortar retailers versus, if everyone got used to buying everything on Amazon, are they going to, want to continue to do that? Are they going to return to the brick and mortar, or they just find purchasing through Amazon is a more convenient way to do it? So there's a lot of consumer behavior issues that have to be dealt with as part of this. But if we go to the next slide, it's just kind of the categories we were just talking about. I think most people are familiar with these types of categories and what businesses fall within each one. But I think it's just important to just say that that's one of the first steps of things that we have to look at. So I don't want to, steal everybody else's thunder. So I'll turn it over to Dan and let him speak towards some of the actual methodologies.
Thank you, Kevin. Over the next few slides, the panel will specifically address how this current environment might necessitate some changes to the valuation approaches that we apply to operating companies. Now, the effect on the appraisal of closely held asset holding companies will be addressed later on in the presentation. Now, before I get started, I just want to make a few points. First, the general discussion of valuation approaches can get pretty technical at times, particularly when it's given by valuation professionals who enjoy it, who do it for a living. Now, our goal is not to train and try to coach everyone to a current understanding of how to apply these methodologies. But at the same time, we're trying to provide some insight. I suspect, as Marty had said earlier, as Jonathan had said earlier, as everyone has said earlier, everyone will be seeing more valuations going forward, particularly in this current environment. Giving some perspective on how you should assess the usefulness, correctness, accuracy of those valuations might be enhanced by understanding how appraisers might look at these things in this current environment. And secondarily, I know with other close advisors, you spend time speaking about your clients' companies, what their values might be. So hearing how appraisers might assess that value from the outside might assist you in those conversations. So now on this slide, we're focusing on the income approach. Now, generally speaking, there are two subsets of the income approach. One would be the capitalization of earnings method, and the second would be a discounted cash flow method. The primary and complementary elements of both are, one, what's the company's expected cash flows, and then two, what's the riskiness of those cash flows, and what rates do we discount them when we value them. Where these two differ is the perspective and assumptions around cash flow, but where they're similar is the element of discount rates. So let's start there for a minute. Now, before we delve too deeply into this discussion, let's take a step back and let's take stock of a very broad observation here. This pandemic and the related economic impact, I think, can be generally agreed upon has led to an increase in perceived equity risk. And that risk, as Todd and others mentioned earlier, might be particularly acute when you're looking at things from the standpoint of a small privately held business, not the multinational billion-dollar companies that underlie some of these indices. So keep in mind, the discount rate we apply on a specific case moves inversely to value. The higher the discount rate, all other factors held constant, the lower the value. So understanding how appraisers come up with their discount rate in this environment is increasingly important. Now, when developing a valuation date for discount rate for valuation purposes, appraisers often start with a known and a safe rate, okay? And that's typically the yield on a long-term treasury bond. Appraisers then add successive risk premia to this known and safe rate to account for things such as returns required on risk assets like common stock, further returns required on small companies, further returns required on companies with a unique risk profile. But as you can see, the starting point matters. And hearkening back to Todd's earlier slide on the AFR rate, the risk-free rate has declined substantially over this past year. I know that in a few days in October, the yield on a 20-year treasury bond dipped below 1%. So appraisers that are applying a rote formula to derive a discount rate could run the risk of yielding a discount rate that is below, in a post-COVID world, that is lower than it was in a pre-COVID world. And that simply does not make sense in most instances. So the valuation firms that you are working with should understand how the world has changed. They should have a good view and a well-developed thought on how they plan to adjust their methodology to reflect the new risk of this environment. So now let's get back to the primary differences between a capitalization of earnings method and a discounted cash flow method. Again, that generally relates to cash flow. So practically speaking, when you're looking at a capitalization method, analysts look backward. They look back at how a company might have performed. They look back at the highs and the lows to understand why they were high and why they were low, and with a view to generate or develop some normalized, recurring starting cash flow rate. That cash flow level will then be assumed to grow at some constant or similar rate going forward into perpetuity. Now, when you overlay everything that everyone is reading in the press and what we've talked about today, that approach can become problematic. Companies have closed down. Some of their primary retail outlets have closed down. The demand for their product might be significantly reduced. In certain cases, things can continue to get worse before they get better. So picking that single point estimate of what cash flow might be is particularly problematic at this time and makes it a challenge to use this methodology. Now, I do want to go back and echo a point that Kevin made earlier, in that there are no absolutes in valuation. Every approach that we apply is specific to the situation and specific to the client. So please take my comments as general background as opposed to specific guidance as to what applies and what doesn't. Now, notwithstanding all the issues we just talked about on the capitalization of earnings method, all is not lost. The second subset is of the income approach is the discounted cash flow method, and this is where you look forward, and you're not really bound by the same constraints. So broadly speaking, it's more flexible. You can incorporate the economic impact or the impact of a company being temporarily shut down. You can capture the strong downward trajectory of cash flow over the next several months as we work through and readjust operations to account for this pandemic. You can account for potential recovery in the years to come, and the question of to what level the company will ultimately recover. Now, what you can quickly see is that we are looking into a crystal ball here. So to echo your earlier point, Marty, you're absolutely correct. How can you come up with a set of forecasts that are truly accurate in light of everything we had just mentioned, and also in light of the cloud that continues to exist over the future? The answer is it's truly impossible in most cases. But what is possible is to understand what the sources of uncertainty are, and try to make assumptions around different states of nature and develop scenarios. Now, you can see that this focus on scenarios and the future allows the client and allows the appraiser to focus on these large areas of uncertainty. As you'd mentioned, Kevin, what is the shape and what is the duration of this recovery? No one really knows. As the company goes through this span, will the company invest in its cash in its operations, or will it divest its operations? Will it add to inventories? Will it take down inventories? Will it add to its capital stock, or will it determine that its investments in real estate or other fixed assets is less now going forward? These are all things that the discounted cash flow analysis will capture. Now, what I'm sure the first thing that one of the participants to this call will realize is that this is really hard stuff, and truthfully, this requires far more diligence and management interaction than we have seen than in the past. And that, of course, is all true. In various cases that we've worked on, in truth, the diligence process has been slowed not because of the interaction, but simply because management's attention is diverted to other necessary avenues, such as putting out fires, wearing multiple hats because furloughs are in place. So I mention this only to echo the call to action from Marty and Jonathan that, particularly in estate planning, time is of the essence for a number of reasons. It's possible that the process of valuation might take longer because it is more robust and because management might not be able to spend as much time during the diligence process as they would have liked to. Scott or Kevin, do you have any color to add to the discounted cash flow analysis or the income approach?
No, I think you hit on some of the key things. I definitely like the multiple scenario approach because you can deal with management when you do see those. It's something you can talk about. Whereas when you deal with the cost of capital, and some appraisers might try and take a cost of capital and put all the risk in one number, a cost of capital, and that's very hard to defend and very hard to know really what the impact is. So having those alternate scenarios, I think, makes a lot of sense. In terms of, it's weird. Some businesses, we have, oddities out there. We're doing some work on a restaurant, a small restaurant with a big name, and they closed down. And talk about asset specific. They are going gangbusters, bigger than they ever have been because of their takeout business, which they never did. Now they're selling, they've got lines outside their tiny little restaurant and selling takeout. And they were concerned that the value would be higher, than pre-COVID and when they reopened because of the number of seats in the restaurant. So you get weird things. And another thing related to cost of capital, Dan, that I'm sure you guys are seeing, is that if a company actually has say $5 million in debt, it's a fixed number. But if the outlook has dropped, now you've got a lower total company value, and you've got a higher leverage. So you get these strange occurrences of a cost of capital that looks like it might be dropping, given some of this stuff. And as you get more leverage, it's sort of like real estate, where you have a income producing property that used to be 50% leverage. Well, the value of that property just dropped by 40%, and now you've got a 90% leveraged piece of property, and that can be very confusing and problematic to value because of the leverage issue. So there are some anomalies out there that are going to play out, and but I think what we're talking about here makes a lot of sense. We need to look carefully at some things that we used to kind of take for granted or historically could average, which we can't anymore. So
Can I ask you guys a question? And if it's silly, you can say it's silly, even though we're on tape being recorded. I'll go out on the limb. In my mind,
all non-authoritative.
what I would kind of almost envision you needing to do, listening to your comments, is almost do sort of a decision tree with an assign of probabilities. So I'm going to do a valuation based on reopening in 2 months. I'm going to do a second node on the decision tree where there's a resurgence in the fall, and we may have a little blip now of revenue, but we're going to have to clamp down again, and it may be 6 months before we get back, or 8 months before we get back. So you may have 3, 4, 5 different possibilities. And even if it is sort of a judgment call to assign probabilities as best as you can, but at least you now have a methodology and roll those back. Is that conceptually what you're kind of doing?
In a simple form, we're doing it more simply. Usually a client's fee consciousness wouldn't allow quite, that kind of analysis unless you jump to a Monte Carlo kind of simulation. But as Dan said, if you're using different scenarios, recovery scenarios, and since you're kind of shooting in the dark anyway, if you come to a reasonable weighting of reasonable scenarios, 3 reasonable scenarios, or 4 if need be, you'll probably get to a defensible answer without having to get too complicated. And and I'm sure, I know Dan Todd would agree, you got to keep your end user in mind, and the end user is not only the client but primarily the IRS. And if you get too complicated in some of this stuff, it becomes more difficult to, get a closing letter on, the work. So, and explain it. So, we try and find that happy median where we get to a good, reasonable answer. Todd and Dan, any thoughts?
I agree with those comments. And just one other, perhaps it's obvious. You're absolutely right, Marty. We can set out different states of nature in the world. We always have to keep in mind that with every scenario that we put forth, it doesn't necessarily bring more truth. It just brings a potential range of outcomes. And then what we might see, though, is that the number of assumptions that underlie these forecasts expand exponentially. And so perhaps you could be creating perhaps more heat than light in various cases when those assumptions aren't well-founded or drawn out of history.
Yeah.
So the final comment, it almost seems to me that more than ever before in history, you need to make sure that you're working with an appraiser who's documenting and understanding those assumptions, because that's where you're going to really have a potential problem with an IRS audit if you can't explain the underlying assumptions. And if you don't have them documented, because everything's so fluid and changing so rapidly, if you don't document and think through what you've done at that point in time, so it may be very valid when we've done the appraisal, looking with hindsight, it could be very detrimental. And I'm kind of thinking again of those, well, my accountant will do it. Well, your accountant's really not an appraiser. I know, but he can do it. It's cheaper. This seems to be an unusually dangerous time for that cost savings measure.
Absolutely. Ultimately, the accuracy of our valuation, which will be cast in incredible uncertainty, will be judged relative to what actually happened, which we can all argue is unfair, but what is actually what happens under audit. So to your point, having a well-founded, well-documented rationale for the assumptions and methodologies you apply is critical.
Yeah, and one interesting thing, Kevin does a lot of the sports work for us. Kevin, I'd be curious, what do you hear on that side of life? Talk about complex valuation work.
Sure. Yeah, that's probably as complex as I'm seeing in any field, because I think it's certainly more publicly known or publicly discussed as to how these sports leagues are going to be coming back into play. But the clients that I'm working with in that field are working through different scenarios, with fans, without fans, shortened season, full season, all kinds of things like that. So that's all very difficult to kind of work through. But to everyone's point, and just to reiterate, I think the documentation of those assumptions and the report and the detail and the level of detail you get into in the narrative report becomes crucial, because writing it up and describing what it is you did and the support you have for those assumptions is vital, so that when you're looking at this after we all know what happened, and if for some reason what happens in the end is different than what we were projecting, we want to have enough support in there to say this is what we were thinking at that time. So that documented report is very crucial.
So maybe I'll add that PowerPoint valuations probably are not good for this situation.
Should we go on to the next slide, folks?
Yes, sir.
Okay.
So now we're moving on to the market approach. And just very quickly, the market approach is all about drawing valuation indicators or multiples from either publicly traded companies or companies that were acquired, and applying those multiples after comparison to the subject company that we are engaged to appraise. So I'm going to focus on the guideline public company method before turning it over to Scott to provide some insight on the transaction method. Now, I guess you could see as following the discussion on forecast scenarios, decision trees, the development of projections can be a very laborious one, and one that is time consuming and also deals with tremendous amounts of uncertainty. And when you overlay that onto a situation when, for a client that has never prepared projections, might not have tracked history that would provide the raw materials to prepare projections, it can become problematic. And so depending on that specific client circumstance in this current environment, applying the wisdom of the crowds, so to speak, through the guideline public company method might be even more useful. Firstly, it offers real-time assessment based on the individual analyses of thousands of investors. So these investors are expressing what they expect for a given company and industry and determining what they think the present value of that company can be. So that present value would be used to express a multiple of historical earnings for that subject company. And one might say that by expressing a current indication against historical earnings, you could divine what the market might feel the probability or risk of attaining those historical levels of earnings might be for a company in a given industry. Also, for widely followed companies, widely followed from street analysts, you might be able to develop forward-looking multiples. You might be able to express a current company's worth as a multiple of its next year or 2-year forward outlook. Now, as I said, there is a benefit because the market approach answers a question. It provides a very objective assessment of how an industry might be valued. But that's not to say that that approach is without concern, and it's quite the contrary. Now, one primary concern that we always have when applying this approach is how truly comparable are these companies that you are determining, that you are using. And let me be the first one to admit that it is very, very hard to find perfectly comparable companies. There is judgment that's required in every case. But in the past, we've seen guideline groups develop with companies that share obvious industry characteristics with the subject company, as well as broader demand drivers for their products. And so in many instances, when we look back at the economic times that we had come through, it's not uncommon to see that those similar demand drivers dominated the relationship and made the comparison between our company similar. They might have trended upwards or downwards from a revenue or profit standpoint. They might have trended similarly from a margin standpoint. But now turning the clock forward, what was once subtle differences in business line or sub-industry distinctions between companies in the guideline group, among the companies in the guideline group, and the subject company might begin to dominate. And those differences might start to make all the difference. It might make the comparison between the companies in that group to the subject company much more difficult, less insightful, and perhaps not as relevant. So one way I thought it might be best to illustrate this is by way of example. We have a recurring client that's a large M&A advisor. So by extension, their results are influenced by global M&A activity, and by extension, global economic activity. So although they're focused on one particular industry vertical, which I won't get into, the activity in that vertical was not that different than we saw in activities of many other verticals. So when we pulled back, we saw that their performance was similar to companies that are like them, M&A advisors, but might deal with different elements of that advisory process. So we apply the market approach. We compare them to similar transaction-based companies, public companies. What we found is that the multiples of those companies as a group were similar. There was some dispersion, but the dispersion wasn't great. The performance of those companies, again, was similar. Everyone was benefiting from the same strong economic times and strong M&A environment. Roll the clock further to today, and you start seeing some divergent performance within that group. Number one, the valuation multiples, even within that group, started to diverge. As we looked further, what we saw is that even sub-industry categories among the companies in the guideline group mattered. There were some companies whose multiples were impacted tremendously. There were some multiples that were impacted less tremendously. As we looked further, we saw that some of those companies that were less reduced from a multiple standpoint had lines of business that were more unique. Perhaps they had restructuring lines of business, things that a more challenged economic environment might benefit. Our client does not have a restructuring business. We saw that the companies that were impacted most were generalists or ones that benefited from strong IPO markets. Our client's not a generalist. our client doesn't take companies public. So the point of this example is that who you include in that guideline group and how you distinguish the performance and multiples you observe from that guideline group has only gotten more important. So although the objectivity of the market approach is a draw, particularly in this environment, one must be careful on who they include in that approach, because those nuances now perhaps matter more than they had in the past. So one final point I'll make on the guideline public company data relates to forward-looking information. As I mentioned, for widely covered companies, you might be able to look at multiples of next year or 2-year out earnings. In many cases, we try to harvest that information and apply that to our client situation. So here too, we must be a little cautious and take time to understand the data. We need to understand when and if the analysts covering those companies have updated their outlook. There could be a case where, particularly in cases where management has stopped giving guidance, where the analysts have not updated their guidance, and that would cause a mismatch between the multiples that we would derive and also the multiples that we might apply to our client's forecasted earnings that actually do forecast or do capture the effect of a COVID or pandemic reduction. Scott or Kevin, do you have any further comments on this?
Yeah, I think you've made some great points. And in fact, we've had the same situation, the exact same situation you're talking about, but in the entertainment area, where when we started to look at forward multiples of expectations, earning expectations of analysts, in May, a lot of the reports that were out there were pre-March. So, it was not reliable. And in fact, our client did exactly what you were talking about, and that is quit giving guidance, to analysts, even though there are some analysts that are doing their own guidance. It did. Am I giving, let me just turn my volume down. I'm not sure if I'm creating it. But anyway, so I very much agree, and I think ultimately we tend to use where we've got companies that in this case probably as a reasonableness test, unless it's a unique market where everybody is similar, and those do occur on occasion. You have some good comps, but I think we'd agree in this environment, a discounted cash flow is probably the safest, to go after, using with this as maybe some kind of a confirmation, if you will, as a reasonableness test as to where you're coming out. Keeping in mind that you got to make size adjustments, you got to make other adjustments, to make sure you're not overvaluing a company that's much smaller. That would be my only comment to that. You want me to? I'll maybe tackle the guideline transaction method. That's my favorite method to dump on, because in fact it's very, very difficult to actually come up with good data in this area, unless you're talking about huge companies where you've got full 8Ks, on transactional information, looking at pro formas and the like. Most of the guideline transaction databases are limited in terms of, you may be able to get some multiples, you may be able to get some revenue multiples, you may, if you're lucky, you'll get some other multiples, EBITDA, maybe, with owner comp adjustments and things. The problem is you don't, if you've been involved in transactions, and I know, with Dan and Todd, and we've been involved in, we see transactions and what gets reported quite frequently, with all the bells and whistles many transactions have, or what's actually being sold or not sold. What gets reported in these databases, by luck, end up reflecting what actually was the underlying economics of the transaction purely by luck. So, and now we're in a situation where transactions really have not occurred. So transactions you'd be looking at are actually probably pre-COVID. So it's a very difficult method, I think, to apply in most instances, and the data that's there is probably not terribly relevant. On occasion, and I'm sure you guys have, the client will actually provide us with their thoughts and maybe even some inside data if they track it, if it's a big enough company and they have a treasury that tracks transactional data, and they get the offering memorandums and things like that. So you get better data and non-public data, but it's still all for this period. It's not terribly relevant. So with that, I would I guess I'd move to the next slide.
Not yet. I got a question for you all.
Sorry.
And I'm gonna even ask Jonathan to weigh in on this. So I'm sitting here getting nervous. So I hire all you bright guys to do an appraisal for me for a client. What is my responsibility? And I'm gonna ask a second part to the question because maybe you want to answer them all together. What is my responsibility as the estate planner, let's say doing a note sale or a grat transaction or even just a plain old gift? What is my responsibility and role in reviewing the appraisal that you're creating? I mean, I think anyone listening as a non-appraiser to the detail that you've just gone through, which I'm sure was just, you're barely touching the surface. And I must acknowledge to the audience, I was very nervous with these guys that they only had like 44 slides and how are we going to fill, 90 minutes. And I'm looking at the clock and I'm thinking we're going to go beyond 90 minutes to get through it. So I apologize humbly to all these bright folks for me underestimating how much they had to say. But from a practical perspective, let's say a lawyer, an accountant who's not being the appraiser, a financial advisor who's helping with the wealth management and the estate plan, a non-appraiser professional, it almost seems more dangerous than helpful to spend 2 hours and read through your appraisal report. Should we even be doing that? Jonathan, maybe you could comment on what you see our role as, and maybe the appraisers could comment, because it was complicated, I know, before, but now with all these COVID variabilities as well, it's even more complicated. What is our role? Should we be involved?
Well, Marty, I think that the attorney ultimately is going to have a great bit of responsibility, if not liability, for what happens. I've always read the appraisals. 95, 98% of it is very boring stuff. But you've got to read it so you can understand.
You guys with that comment, they were getting all worked up over this.
No, it's true. They love this stuff, but we find it boring. But I'll tell you what I do. When I see a discount of 29%, I always ask, why not 30? Why not 28? One of the big 4 accounting firms, when I asked that question, said, well, we know. I said, how do you know? And they said, because we are this great accounting firm. I said, that's not going to impress an IRS agent. It's not going to impress a judge. The appraisal should be prepared so you can understand it and it makes sense. If they say they want to use this or they want to use that, the question is why? Because those are the kind of questions that the appraiser will be asked to understand if this thing goes to trial, or even if you meet at appeals with the IRS. It's critically important to me that the lawyer or the accountant who's ever going to prepare the return and is ultimately going to be the one who's going to defend it has to understand it and has to, on his or her own, be able to defend it before you call in the appraiser himself or herself. And I feel that every time. But yes, Marty, you need extra coffee to read most appraisal reports.
So your perspective is that we're not reading it as an appraiser, but we're really reading it as a non-appraiser to make sure that we can understand it in a non-technical way and that the logic flows.
That's exactly right. Because when you're meeting, say, with an IRS agent in an estate tax audit, and the agent says, well, you know, I don't agree with this. Again, you can go back and say, tell me why you don't agree with that. What do you find wrong? The more prepared you are, the better able you're going to be able to pepper that agent back with some really good questions.
When you say
And one of the
Pepper, you mean Dr. Pepper?
Dr. Pepper, and one of the things I don't think that most lawyers understand is when the agent comes in and he says, I don't think it's worth X, I think it's worth 2X or 1.5X, you can ask the appraiser to tell you how they've done that methodology. The code requires that within 30 days of making that request, the government must tell you its valuation methodology. And I'm telling you that more often than not, when you ask that and press them and tell them the section of the code, it never comes up again. I've used it dozens of times with success. But again, you've got to be able to defend that. You've got it there. I understood it. And that's a very powerful card you have to play if you really understand the appraisal from a logic perspective, why they chose the value, a particular valuation approach, why they took a particular discount. You've got to be able to do that. Why did they use something, whether, the guideline transaction method as opposed to the guideline public company method, if they did it at all? Sometimes they'll take a look at both and they'll weigh one twice and the other one once. The question is why. And I can't stand it when I'm told, oh, well, we've just done this so many times, we know. That's not going to impress a judge, and it doesn't impress me. These guys that I've dealt with do a great job on that. But if you're hiring an appraiser, you have to pretend you are from the IRS and to begin to challenge.
Good point. Yeah.
Yeah, Marty, I would say you should absolutely ask, let's get on a phone call. Please walk me through your draft. What did you do? Tell me in simplistic form, what methods did you use? How did you go about it? Explain it to me, because I don't have the technical expertise as you do. Can you explain it to me in 20 minutes? Jonathan's exactly right. Ask why at those logical points in time. When it comes to discounts, which the IRS often views as low-hanging fruit, put the appraiser on the spot. Make sure they can tell you how they came up with the discount, what factors went into it. Same goes for the discount rate. In a DCF, let's say, you can, multiples, well, how did you pick 7 times or 6 times? And if they can articulate in a somewhat brief call, in a way you can understand, then I think that is a good approach and good for you and your client.
Any other comments or thoughts from any of you?
I would just say that that's certainly the right approach, and what I think people should take away from this is not so much that you need to understand everything we do, but maybe to at least know what questions to ask of us, to make sure that we did look at all of these things and make sure that we do have all of our assumptions supported, and we use the right methodologies and can support our work. So.
No, I think that was very helpful, because I'm sure a lot of people watching this are saying, oh, that's complicated. I'm not going to follow all that. What am I going to look at? But I think this was very practical to give some insight into what we as the non-appraiser on the team can do. And I think being that objective, hey, how did you get here, is something, because you're so immersed in it. Maybe you knew it and you did the analysis but didn't mention it. Could you add it in? So I think that was very helpful. Now we can go on to the next slide. I'm sorry about that, but I just kind of thought a lot of people might be thinking on that.
So Marty, question. We are what? How's our time? Do we want to skip? Oh, okay.
We're going to cover it all.
Okay, great.
And if somebody feels that it's a little bit extra in terms of time, they can come back and watch it. But I think we got great content, and this is so essential, as we said in the beginning, for everyone in the estate planning world, whether they're an attorney, an accountant, a financial advisor, whatever, trust off, anyone involved in planning needs to have a better understanding. And what we just went through, why you need to review, as Jonathan explained, how you need to review an appraisal report, to me, that's probably one of the most critical lessons or pieces of education that we're providing to the audience. So if we go a few minutes over, it's fine.
Might be more than a few, but that's good. We got a lot of good material.
I humbly apologize for underestimating how much you all had to say.
We are just a windy group.
You know, I always thought it was the lawyers that had a lot of hot air, but I won't finish the sentence.
98%.
I won't say I told you so, Marty. I'm not going to say it.
That's
You
right.
can say it, you did.
That's right.
All right, let's roll. We're on slide 22, everybody.
Yeah, so I'll just address a few of the points here, and you know, after I address a couple points, I think Todd wants to address the one dead smack in the middle. So, you know, we've already talked about the kinds of issues, you know, that this has created, and you know, companies are not going to necessarily survive, you know, the shutdowns and other factors. So, you know, there's a lot of impact, and that can have an impact even on a supply chain, as companies, you know, at one part of a supply chain have problems, and now it affects others, you know, further up or down. You know, we've talked about the complexities. You know, this is sort of a summary slide. We talked about the complexities of modeling, you know, more onerous, hopefully more fees. We don't know, but it's certainly going to take a lot more analyses. One of the things that our valuations, and we've alluded to it in the discounted cash flow method, is that we need to try and understand the longer term impact, because you know, you have at the end of your projections, you're trying to project what's the growth in that business and in that industry. And some of our, you know, these businesses, their longer term growth is going to be, you know, hard to figure out really where, whether it's going to be a 3 or 4% or a 2% kind of longer term growth, or where that's going to be, and that will have a big impact on values. You know, the differences by company, by industry, and geography are going to all play a big role. And you know what industry you're in, if you're in energy, if you're in restaurants, retail, etc., all going to need to be looked at, you know, very, very distinctly. And Todd, you wanted to address the preferred stock and the like. Why don't I turn it over to you?
Sure. Yeah. Thanks, Scott. So, you know, as appraisers, we are not only asked to value common stock in private companies, but often we're asked to value preferred stock and debt or notes. These can be attributable to third-party investors or to family members that have injected money into the company and have a senior claim relative to the common shareholders. These senior claims are forms of leverage. Now, often, especially in normal times, we will value these senior claims based on factors such as asset coverage, earnings coverage, and consider whether an adjustment to par value is needed to reflect the characteristics of preferred or debt versus comparable securities that one could purchase in the secondary market. However, in this environment, the enterprise values of a meaningful chunk of leveraged companies have fallen significantly, especially those in the hardest hit industries. I'll give you a quick example. We just finished appraising preferred and common equity in a specialty finance company that lends to consumers with poor credit who are restructuring their debts. The firm was doing very well pre-crisis as the economy was strong and unemployment very low. Needless to say, when the crisis hit, layoffs started, and due to a host of other factors, the business has been damaged substantially. So much so that the enterprise value is now less than the face value of the preferred stock. So what do we do in a situation like this? There's a few different methods, but one method, which hopefully you can follow, is to treat all the tranches of the capital structure as call options on the enterprise value, where the tranches participate in the allocation of value subject to hurdle rates. So in a simple example, if you've got an enterprise value that you've determined is $30, but the preferred equity has a face value of $50, we say that the common stock effectively is an out-of-the-money call option on all or a portion of the value exceeding $50, with the remainder of the enterprise value then allocated to the preferred. So let's say we value the common stock as an out-of-the-money call option, Black-Scholes model, at $5. We subtract that 5 from the enterprise value of 30 to compute the fair market value of the preferred to be $25, or 50% of the face value. So that's a simple example. The takeaways here are that debt and preferred may need to be valued differently due to the crisis and potentially at steep discounts to the face value. This should be kept in mind for state tax reporting purposes. If the decedent owned preferred stock or notes, and elsewhere, this may create a planning opportunity if your client is optimistic about a recovery in the underlying business, or if the client might be contemplating forgiving an outstanding loan. So I just wanted to comment on that. We've seen that recently, especially with highly leveraged companies. It's an interesting dynamic. Kevin, I want to kick it back to you now. I think we're going to have some discussion. Oh, yes, go ahead, Marty.
For us mere mortals, could you just explain in 10, 20 seconds, just high level, what Black-Scholes is for people that have not heard of it?
It's a tool for valuing a stock option. You basically, based on inputs such as time and the volatility of the stock, it provides a value for the option to buy the stock at a certain time and at a certain price.
Okay.
So it's a tool, it's a formula to value a stock option.
Okay, I just thought that would help. Sorry to interrupt.
No problem. So I think we're going to go to the next slide for Kevin to talk about the CARES Act.
Yeah, sure. Thanks, Todd. So basically a lot of the focus that we've been talking about so far has really been on the negative impacts that all of the quarantining and business shutdowns and the like that we've seen. So on the other end of the spectrum, probably the most significant legislation that's occurred during this period of time is the CARES Act and the stimulus money that's been surrounding or that's been pumped back into the economy. So there's been the initial CARES Act, there's been version 2, and they're even talking about version 3. So I won't spend a lot of time on this. There are webinars out there that are, 2 hours long that go into all the details of all of this. But as it relates to the stuff we were just talking about, like the discounted cash flow, trying to project future cash flows, these are all things that we as appraisers need to kind of pay attention to. And as advisors to these clients, need to make sure that they're thinking through and having opportunities to take advantage of these things. So under the CARES Act, there's really kind of 3 buckets of benefits. One is certainly the funding. The second and third are kind of tax relief concepts. So under the funding category, there's the PPP loans, which I think probably everyone's familiar with. It's the one thing that's being discussed in the news all the time, the Paycheck Protection Program loans. So the changes that just recently occurred have probably suggested that the vast majority of people who took out loans are going to actually get those loans forgiven. So I think one of the things that people need to understand is that while it seems as though it's free money, the reality is that there is going to be a tax impact to that money, because the expenses that are being paid by the proceeds of those loans, because the loan is forgiven, those expenses are not tax deductible in that given year. So in essence, you're going to be paying taxes on the money that you received as part of that loan. The EIDL loans, or the Economic Industry Disaster Loans, those are another version. They're more of a grant in some ways, but the one that most people are familiar with are the PPP loans, and that's really pumped a lot of money into companies. So to the extent that they're going to be forgiven and they're going to have the extra cash in their balance sheets, we need to kind of take a look into that as appraisers and figure out whether or not, and depending on the industry, whether or not that's money that they can use maybe for future investment, or is it money that really just went out to as intended, which is to keep people on their payroll and to make sure that they've got money going out into the economy. The second and third categories, real quickly, there's payroll tax relief. So there's all kinds of legislation around the the paid sick leave and the family and medical leave acts. There's some expansions of all of that for folks that got sick. You can get some deferrals and credits on your payroll taxes. For example, your Social Security taxes, you can defer the rest of this year's Social Security tax and then start paying them back next year or the year after. And then there's also some little talked about income tax relief. So there's many items that were in the tax acts of a couple of years ago that Trump passed that have been tweaked, how NOLs are treated, the ATM or AMT credits, interest deductibility and the like. There's some specific items there that are being handled a little bit differently. So as we work through some of the income statement projections that we have to work through, we need to make sure that the current rules are being followed and we understand what those are. So with that, I'll turn that back over to you, Marty, so we can move on to the next topic.
Sorry about that. I was just muting everybody to avoid some background noise. So we're going to switch gears and go on to our next topic, and we're going to try to speed up a little because we're kind of out of time, but let's cover everything just maybe a little more rapidly and I won't interrupt as much. What about valuation discounts, the elixir of planning that we all get so excited about? It's often an important piece of the puzzle in a wealth transfer plan. Have discounts been affected by the crisis? Great question.
Sure, and I'll start with the first part of this before I hand it off, and I'll try to go through it a little bit quickly. So the first discount is the discount for lack of control, and what I guess most people probably understand what that is. So it's almost kind of self-explanatory to some degree. But for limited partnership interests or non-managing member interest in LLCs, or even minority interest in stockholders in C corps and S corps, if you don't have control over things like salaries and distributions and sale of assets and liquidation and things of that nature, then your stock is considered to be a little bit less valuable than the person who actually controls all of those items. So to effectuate that difference in value, we apply what we call a discount for lack of control when we try to separate the difference between the control value and a minority value. So most often you're going to see discounts applied in a discrete way when we're valuing using the asset approach methodology. So most often that's going to be real estate holding companies, marketable securities holding companies, or other illiquid assets, but more of a holding company structure where we're using an asset approach. There are other times that you'll use an asset approach, and there's certainly applicable or situations where that's applicable, but really the most times you see it in a holding company structure. And what we generally look at are try to find some benchmarks to say what are equivalent traded assets in the marketplace that are akin to the asset structure of the holding company. So if you've got real estate, you're going to look at real estate-based investments. If you've got marketable securities, you're going to look at, say, closed-end funds, things of that nature. So what we look at is the traded price relative to their reported net asset value. And that discount is generally perceived to have a lot to do with the lack of control, and we use that as a proxy for the lack of control. So what you ultimately end up doing is applying different lack of control discounts based on the different asset mix of the holding company, and you end up with kind of a weighted average concept, which then can be adjusted for certain characteristics such as the size or the diversification, liquidity, management competency, things of that nature. So what's happened to the discounts during the crisis, as one would expect, given all of the uncertainty and volatility that we've been talking about throughout this webinar, the discounts have risen. And if we move to the next slide, Marty, the first slide here kind of shows a sample of different types of closed-end funds that one might look at as an example. This is first quarter of this year. So as we said earlier on, valuation date matters. So if you look at 12/31 valuation date, you've got different samples here. The capital appreciation sample would be for using, say, common stock type investments. Real estate is going to be obviously real estate investments. You can see that the discounts have started off at the end of the first quarter. By the end of the first quarter, they were significantly higher, and obviously at the end of March, you were knee deep in all of the pandemic and the concerns, and all that was probably close to the peak of everything. And you can see the discounts went up in some cases almost double, but at least several hundred basis point increase in the discounts. So as we kind of move through the crisis, and if we move to the next slide on page 27, you can see this is sort of the second quarter up through June 15th. Obviously, we're not quite at the end of the second quarter yet, but you can see that the discounts more or less have held constant as the volatility is still there, the uncertainty is still there. So back to what we talked about before, where is this still a good time to gift, even though maybe the markets have come back to some degree, so the underlying asset value isn't as low as it used to be. At least the discounts are still there and at higher levels than they were pre-COVID. So you can still take advantage of those higher discounts. So I'll leave it at that for the lack of control discount, given our time constraints, and I'll throw it over to Todd to talk about the marketability discounts.
Yeah, so when we're doing valuation of a closely held business or investment partnership, there's usually two discounts: the discount for lack of control that Kevin's gone into, and then the discount for lack of marketability. And fundamentally, the reason for this, of course, is because you've got a privately held company, very few owners, no transaction activity. If anybody's ever tried to sell a 10% interest in a small business, you know that it's challenging at best and impossible at worst. Now, as Kevin rightly stated, the discount for lack of control varies over time and varies by asset class. Similarly, the discount for lack of marketability is not a static number across asset classes or business interests and is not static over time. In fact, our research shows that there are several company and market-specific factors that are uniquely correlated to the size of the marketability discount, and that by their very nature, these factors vary by company and over time. The appraiser that is able to show what factors he or she considered uniquely to the subject business interest and to the specific valuation date is going to be in a better position to defend that discount if it comes under scrutiny. Quickly, a brief overview of some widely accepted methods by which valuation experts develop these types of discounts. I'll mention two in the interest of time: the restricted stock method, which is here on the slide. Basically, as a source of financing, hundreds of public companies every year raise money privately through what are called private placements or PIPEs. This is a less onerous route than doing a secondary offering, for example. But as part of the deal, investors in these placements are not able to sell or resell the purchased stock in the public markets for a defined period of time. And this often leads to the private placement being priced at a discount to the public market price. My firm, MPI, for example, is then able to scrutinize these transactions and ascertain what variables are statistically correlated to the size of the observed discounts. Now, a second method that's pretty popular is what's called the protective put option method. For those unfamiliar with put options, these are contracts that give the holder the right to sell a stock at a specified price at a specified time. Often investors will purchase put options alongside a common equity position with strike prices roughly equal to the prevailing price of the stock as a form of protection or insurance against a price decline in the stock. And so the cost of the put option or the cost of that insurance is likened or used as a proxy for a lack of marketability discount. And so focusing on these two methods, one of the common threads is the volatility input. So this is a key driver of discounts with private placements and is a key input when running a protective put option model. Both of these methods clearly show that all else being equal, higher volatility leads to higher discounts for lack of marketability. Thus, in the current environment where we can all observe heightened volatility, marketability discounts tend to be higher. And the research clearly points us in this direction. For example, we had a recent case, a diversified investment partnership with a valuation date in May. We ran our marketability discount analysis. We also ran a hypothetical analysis as of the end of 2019, sort of as comparison. And in this case, we developed a discount as of May of 2020 that was approximately 6% higher than what we would have developed if the valuation date was 12/31/19. The end result was a 33% discount that we developed versus 27% if we had a 12/31/19 valuation date. Now, just back on this slide 28, our research on restricted stock discounts has found that not only is volatility significantly correlated to the size of the discount, but there's other company and market specific factors on the data valuation that are statistically correlated to the discount. These include the size of the firm, the price to book ratio, holding period, among others. And so we strongly feel that looking at discounts in this way on a case-by-case basis leads sensible for the client should the appraisal and the discounts come under scrutiny. Now, if we go ahead, Marty, to the next slide, just as one measure of sentiment towards assets where there's an illiquidity component, there are so-called listed private equity funds that are actually exchange-traded vehicles. These are closed-end funds of sorts. In recent days, you can observe that these funds were trading at discounts to their net asset values of about 20% on average versus closer to 10% pre-crisis. If you remove funds that trade at premiums, which might be due to some unique circumstances, it's about a 6% differential. So just another indication from the markets of elevated discounts where you've got illiquidity on account of the crisis. Moving to slide 29, just some qualitative evidence from the market that indicates that higher discounts may be prevalent. Bid-ask spreads are wider. That's a very good and direct indication in and of itself of lower liquidity. In the private equity area, sellers may be willing to accept large discounts just to get out of fund interest where they've got unfunded commitments. So all of these factors taken together point to higher discounts potentially, not only when you're valuing private equity fund interest, which I think we all see a lot of, but lower liquidity in the private markets generally. So Scott and Kevin, do you have anything else on this subject?
Sure. In terms of the restricted stock analyses that you talked about a couple slides earlier, that's a great source of information to use in developing defensible, ways to judge and estimate discounts. I mean, I think, we use some of that same data in just different ways to come up with those. I know the VIX index tends to play a pretty big role in, as a market measure of volatility and has an impact on discounts as well. And so, it's a great way, and it brings it out of the I think it's X to here's all the factors, here's how it fits in, and here's how to justify it. And I think that's great. You talk about the private equity secondary market. It's really interesting. I mean, I've talked to people who have funds that are invested in aviation leases and travel companies and the like. I mean, they're decimated, yet their capital accounts may not reflect it as of March 31st, but, now it's going to reflect. But I think the other thing with the private equity secondary market as well as funds is the COVID is likely to extend. They thought they were a 10-year fund. Well, maybe now they're 11, 12, or 13-year fund because it's going to take time to bring some of the value back to where they want to be able to, ultimately sell those assets. So there's not only a time issue here, but there's also quality of assets. And one of the things that we've been trying to do is to better understand the kinds of assets in some of those funds and whether they're big, winners to date, how they're affected. and whether those industries, whether the fund is actually valuing the outlook for those things in a reasonable way, or whether they're still kind of holding off on reflecting that value. I mean, that would probably be my, and again, it's careful due diligence in figuring out discounts on the whole thing. So that's enough said from us, I think. Yeah, I'm going to sort of take blockage discounts, these will be applicable where you have a client that has large blocks of stock, and especially if they own it related to smaller companies, where the trading volatility, the trading volume and volatility have been impacted, or where the block of stock would take long periods of time to sell. And there's a great opportunity here because we talked about Black-Scholes a little earlier, and Black-Scholes is used quite a lot. Black-Scholes evolving into restricted stock studies, depending on the length of time involved in selling that block off that's being valued. So it's a concept that if there are blocks out there, if an attorney has a client that has a large block of stock and they want to do some transfers, you get maybe a double whammy. The value's down, and these are publicly traded, we're talking about typically, as well as the time frame to sell. So you've got a double benefit from a estate planning standpoint. So maybe you might want to go to the next slide.
All right, so we're going to change gears. I think this may be our last topic, everyone, and we're going to talk about real estate and art. Many clients that we talk to have significant real estate and art portfolios, and wealth transfer strategies often depend on getting those assets appraised. What is the impact of the crisis on these asset classes, and how are these asset classes getting valued when comparable transactions may not be occurring? For those listening, keep in mind that we may have a $1 million gift exemption after the election if there's a change in power in Washington. So clients that have significant collections, art as an example, may not have had that on their primary screen in terms of planning and may have focused on business and investment assets, but it may make a world of sense if they have collections they want to pass on to heirs to do planning for these specialized assets.
Yeah, so on the real estate side, obviously you don't want to be dealing with an old appraisal on the real estate side. There aren't a lot of transactions out there that are in the COVID era yet that appraisers can use as a method. But in a lot of ways, we've talked about all the different impacts on, maybe commercial property, multifamily, retail is, having a difficult time. When I talk to appraisers, they talk about, the need to really go down and look at costs, especially for income approaches. The cap rates are up probably a quarter to half a point, and the cleaning costs and all the stuff associated with COVID for the next few years all mean lower income. So values are going to be down, and then that's on top of the markets have been hit hard with the underlying properties themselves. Plus, lenders have clammed up a bit and are looking for better loan to value numbers. So there's a lot less dollars out there for lending in this market, which means it's going to be tough for lenders. You could go to the last slide on art, I think. So just make sure that the appraisals that you're working with are as current as possible. In the art world, you've got a real dichotomy, and it's a little less easy to say that there have been big discounts. I had a guy tell me on the phone that a client of his has a $5 million piece of art, and he said, if I took this down on the street, I couldn't give it away. I was like, well, I'll take it. Which clearly, just because there haven't been any big art auctions that have tested the market at this point, you can't say it's not worth anything. And in fact, the IRS tends to like to look at post-valuation date information in the art world. And unfortunately, the biggest art deal, the biggest art auction is next week. It used to be May for some of the, contemporary and impressionistic stuff. Now it's happening next week. So we're going to get they're going to get a lot better. The appraisers are going to get a lot better idea as to what's going on in that market. And oddly enough, art appraisers can, I'm not sure if I can, hold on. Well, I'll ignore that. Art appraisers can do desktops, desktop appraisals based on old appraisals and the like. So those can be done. And interestingly, because all of us are sitting at home looking for things to do after we've done our work, the online collectibles and stuff under $10, $20, $30,000, they're actually hitting record prices in the market, interestingly enough, because, I'm even doing some bidding for the first time in my life. Putting some bids in on an online appraisal, online auction. So the smaller stuff seems to not have lost value, but potentially, it's happening there. So it's going to be hard to judge really what's happened. We'd all think that the value of art has dropped, but I'm not hearing that from the experts in that market. So, and with that, I'll turn it back over to your full panel questions. You're muted, Marty.
Sorry about that. I was just trying to keep the background noise down. Let's try to wrap this up quickly because we're really running out of time. Given the upcoming elections, the general political landscape, what does the second half of 2020 look like for estate planners? So just a couple of comments. We should all be prepared for a flood of planning. Jonathan, who had to step out, made a comment early in the program that we should be communicating to clients, plan now because you don't know what the election brings. There's going to be a crunch of planning. Potentially, it could be a tidal wave bigger than 2012. If all of you that remember 2012, keep in mind, we knew well in advance that the end of 2012, the beginning of 2013, we were going to have the exemption drop from 5 million inflation adjusted to $1 million. It didn't happen, but clients knew that well in advance. Right now, we have no idea what the election is going to hold. Many clients are just holding off saying, wait, I'll see what's going to happen. Very dangerous. It's going to be very difficult to get planning done and get appraisal work done and so on and so forth. I think we should, in the interest of time, just wrap up. There's some points here to consider for all of us in terms of planning. But I think we should just, if each of you want to make one quick final comment, we should wrap up. I think we've covered a lot of ground in the program. Scott,
I'll just say, thanks for having us on, and we have remained busy. And if it's going to get a lot busier, I think you're going to have stretched capacity, especially as you get to the year towards the third, fourth quarter. So if people need to start to think about planning.
Todd?
No, I think it's a very complex environment. It's obviously self-serving, but, choose your appraiser wisely. You want to recommend appraisers to your clients that, are going to handle them well and have the experience and have seen these cases before. It's going to be a good thing for you to do as a planner and for the client. Sooner rather than later is a great thought here. And, we've only, the year's going by fast, and it's going to be July here any day. And so, people need to start moving on things. And, there's a lot of good things in these materials that maybe will help some folks out there try to get their clients to move.
Kevin?
Yeah, I'll just echo what everyone else said, but I'll just add that if you have questions, there's a lot of information here. Feel free to reach out to us. I'm sure any one of us is happy to get on the phone and talk through any particular situations. And as people get more comfortable with work environments and the like in the current environment, then they're probably going to be more willing to focus on things like planning and the like. So, the sooner we can get going on it, the better. And, I think that's, probably how the year is going to play out is going to be interesting. So we're looking forward to it.
Dan, you're up.
Just one last comment, a little different than the others. We went through how laborious this task could be, looking at projections, developing projections. You could look to your valuation company to provide more value than just the opinion that sits within the four corners of the appraisal. We'll go through your business. It's a good way to get the advice and get the perspective of people who look at companies, scrutinize companies, and scrutinize projections for a living. So it's time well spent and can create more value than just the numbers in the page.
I want to take this opportunity to thank everybody from Empire and MPI and our colleague Jonathan Blottmacher for participating. I thought it was an incredibly informative and informational webinar. Everyone's email addresses are in the slides, and the detailed bios for each of the appraisers that spoke follow at the end of the materials. You can get the materials on the handout tab while the webinar has been ongoing. The recording of the webinar and all handout materials we posted within a few days of the program on www.schenkmanlaw.com, as well as on the Interactive Legal website. So if a colleague of yours could benefit from this, they can get a recording and all the materials at any time on schenkmanlaw.com/webinars or the Interactive Legal website. We'll make copies available to Empire and MPI if they want to post it to their websites as well. Thank you for joining us, and good luck with planning for the rest of 2020. And it could be an interesting year. Take care, everybody. Thank you.
Thank you.